Hello, everyone. Thank you for taking the time to join us today. We're going to talk about the things that you should be thinking about for the end of the year. And we're not only talking about investments, we're also talking about taxes. And the reason that that's so important, particularly this time of year, investments, what most people talk about who are in the investment industry is pre-tax results. And that's important because that's the starting point, but you can't put that in the bank. Ultimately, you really need to be focused on after-tax performance. And so, particularly as we end up close to the end of the year, we thought we'd go into a couple of these. The tax code itself is absurdly complex, but there are a number of things that you can and should be thinking about right now. So let me introduce a few people at Evergreen Wealth. And the first is Sam Muncy. Sam Muncy is the head of our advisory services. The second is Andrew Leneve, Director of Financial Advisors. They'll talk just in a moment and take portions of what we're going to cover today. "2025 year-end strategies." Here are a couple of things that you really should be thinking about and thinking about now. First, tax loss harvesting. Turn your losers into tax winners. Second, charitable giving. Double the tax benefit with a donor-advised fund. Third, retirement accounts. Fund your tax-deferred and tax-exempt accounts today. Tax gain harvesting. You can eliminate capital gains on your winners by transferring them out for charitable or family gifting purposes. And of course, that brings us to family gifting. There are a number of ways to give assets to the next generation without generating any tax event when you do so, and then having longer-term tax benefits through the transfer. Finally, we'll come back and do a checklist of those things that you should be thinking about over the next couple of weeks. So what I'd first like to do is take a poll, an interactive poll, and you should be seeing something on your screen in just a moment that will ask you your top year-end concerns. Is it taxes, RSUs, retirement, charitable giving, education, or otherwise? Each of these things we need to address in the weeks before December 31st. And so what I'll say is there's one number to remember above all else, and it's not the 1040, it's 29. 29 days, the year-end countdown, before you can, after which you lose the ability to impact this year's taxes. So do we have any results from the quiz? Well, look at that. This is perfect. What everyone is concerned about is taxes and, of course, year-end taxes. So that's a marvelous entryway into the things that we're going to talk about today. And let me first just ask Andrew to talk about the people for whom these concerns are most germane.
Sure. Thank you, Bill, and good day, everybody. Our platform and our services in the session today is really advice that's driven for high-earning working professionals and their families. They are tax-aware investors and almost always time constrained, and that means often being busy juggling careers, family, and maybe other social priorities. Many of you know that a lot of these strategies are there, but there's perhaps a chance that you haven't had the time to execute them or to coordinate them properly. And it's really the coordination of all of these strategies in tandem that truly unlock the full potential of building tax efficient wealth over time. So to begin, there's a powerful tax reducing investment strategy that can be leveraged. Bill, how about I pass it back to you to kick us off talking about tax loss harvesting and how it works?
Terrific. So I'm delighted to talk about this because it's actually my favorite tax smart investment method. And it really should be the foundation for many high income investors. So, how does it work? Even in a rising market, if you have a large number of individual securities, you're likely to have some positions with unrealized losses that are not providing the tax benefit until they're sold. If you sell them before the end of the year, these losses can be used to offset capital gains that would otherwise be taxed. This is valuable if you want to diversify away from highly appreciated securities, if you want to rebalance back towards a target or index, or if you just want to raise cash for any purpose. And then, in addition to offsetting any capital gains, up to $3,000 of the losses can be used to offset other income like salary, bonuses, RSUs, interest income, which is taxed at the higher ordinary income tax rates. Now, these rates can be as much as twice as high as the capital gains tax rates. So it's a terrific bonus. And then finally, any excess losses beyond that can be carried forward and used in any future tax years. So let's take an admittedly oversimplified example. Let's assume you have just two positions. The first position holds a $32,000 gain. The second position holds a $42,000 unrealized loss. If you just sold position A, you'd recognize the gain and pay taxes on that gain. If you sell them both, then your net position is a $10,000 loss. So, first of all, you pay no taxes. You've raised a bunch of cash that can be used for multiple purposes, reinvested or taken out as cash. And you've got, in addition to that, $10,000 of excess tax loss. How to use that? Well, the first thing, obviously, is you take a $3,000 credit against ordinary income. And then second, you still have $7,000. That carries over to the 2026 tax year to be used then. So all of this can be done manually, and that's the way that the industry has typically done it. In December, at the end of the year, you or your advisors get an Excel spreadsheet and try to figure out, all right, which of these do you want to sell? It's roughly effective, but there's a better way to do it these days. It's called direct indexing. And think of it this way. It's similar to having an indexed ETF, but instead you own the individual underlying securities rather than a single ETF. Now, from a practical point of view, this is not something you can do by yourself. However, there are a number of firms, including our own, who can do this for you. And then what you get is harvesting disciplined, systematic tax loss harvesting throughout the year, and then using those losses to rebalance your portfolio and, and without incurring individual tax. And this systematic approach also avoids the pitfalls of reacting emotionally to the ups and downs of the market. Whether you're doing this manually or whether you're doing it in a systematic way, if you repurchase the same security within 30 days of the sale, it's a wash sale, and you have to avoid this. Because in a wash sale, your tax losses are then subsequently disallowed for tax purposes. Now we come back to the urgency of the clock. In order to get those benefits in this taxable year, you have to make the sale on or before December 30th. So don't wait. There are too many things that are bound to come up in the holiday season, so do it now in the next couple of weeks. So how much can you save with a systematic approach to tax loss harvesting using direct indexing? If you're a high income taxpayer in a high tax state, it can be significant. A recent study, assuming a 24% marginal capital gains tax rate, the estimated increase in after-tax performance over a 10-year period was 29%. And the 29% estimated after-tax benefit does not count the $3,000 annual offset against ordinary income, which is, of course, an additional plus. So let's take a quick review of the action summary. You have to review your taxable accounts today. This is not something for your retirement accounts. It's only for taxable brokerage accounts. Harvest the losses and then reinvest appropriately to rebalance towards your target. And then another important thing is remember to document the carry forwards for planning purposes next year. Now, tax loss harvesting, that's only one aspect of what you can do in the tax years. There's a flip side of that coin, which is tax gain harvesting. And let me flip that to Andrew to run you through that one.
Yeah, that's right, Bill. I would say this is the less talked about complement to tax loss harvesting, and is, of course, tax gain harvesting. Tax gain harvesting is all about intentionally harvesting our gains when it makes sense. And this can be especially useful in years where you have a big life event, such as lower than anticipated income, perhaps tied to something like a job change, or if you have those loss carry forwards that Bill just alluded to. And with tax gain harvesting, you now have the opportunity to potentially reset your cost basis at a higher rate or potentially rebalance your investment strategy now in the way you need it without incurring those sometimes punishing tax consequences. So, when effectively used, tax gain harvesting can help you reduce the liability in the future. And it's very relevant for you if you expect that next year may be a stronger income year for you. The key here really is about being intentional. Many investors think that harvesting is only about losses, but we want to be equally surgical in our approach to how we think at tax gains. And two of the easiest ways that we can do this is through family gifting or charitable giving. Really, the goal here is to just take some of your biggest winners to reduce or remove the tax hit that you would expect from those strong investments and also achieve some other meaningful financial goals that you may have in your lifetime. So let's talk about one of the best ways in our view to do that, and that's called a donor advised fund. And this is something that we believe just about every investor should have. It is a vehicle that allows you to donate things like appreciated securities or even cash, fully avoiding capital gains on those securities. Your contributions to the fund are fully eligible for future charitable donations. And importantly, the full value goes to the charity without that typical tax erosion that you would expect if you continue to hold those highly appreciated securities and pay the tax on them. From a tax perspective, you'll receive the full deduction on your investment based on the fair market value at the time of your contributions. And these contributions, again, can be in cash, appreciated securities. But the real key here is to itemize your deductions in order to receive the full tax benefit. And one of the best parts about the donor advised fund as it relates to the benefits or the values for the client is its flexibility. And this is different from many other types of charitable strategies. It actually allows you to make contributions today, but determine at a later date, a to be determined date in the future, where that money is actually donated to. The second strategy that I mentioned is family gifting. Now, as a reminder, each individual is allowed to gift up to $19,000 per recipient this year in 2025 without it impacting their lifetime exemption towards the estate exemption. This is on a per person basis. So a married couple, if they were to approve this gift, could contribute up to $38,000 per recipient. So for a family of five, if you have three children, that means you can gift over $100,000 in annual giving, reducing your potential tax burden and that estate liability over time. So we see this as a great way to systematically reduce the value of your estate over time. And again, hopefully simultaneously achieving some of those estate planning objectives that you might have. So while we've been talking about long-term strategies, wrapping up with a couple of these estate-related items, Sam, what are some other long-term investment or saving strategies that we see our clients taking advantage of?
Yeah. Thanks so much, Andrew. And I'm excited to talk about, I think, a perennial year-end topic here, which is the tax benefits of retirement accounts. I really want us to think more strategically about how we approach these accounts and how we layer these strategies together. As both Bill and Andrew mentioned, these are compounding strategies that we want to use over time. So when I think about this as an individual investor or someone that we're advising here, I really want to make sure clients think of an order of operations. So let's think about those three basic tools. One, we've got our tax deferred accounts. We have our traditional pre-tax 401ks. This is the traditional vehicle of choice. This is what many individuals have access to or may have participated in the past. Of course, there's some tax advantages with that. Wonderful. I'm going to talk about what to do with that at year end in just a second. There's our tax exempt accounts, which is going to be our Roth 401k and then also our Roth IRAs. And then we have what I would consider hybrid strategies, which is going to be maybe using some strategies that employ a Roth or a traditional with some type of active after tax contributions or conversions. The thing we want to think about is that there's an order of operations to this. And definitely the first person to say each person's individual circumstances are different. You want to evaluate this carefully and look at this with all of the individual detail and nuance that you may be experiencing as an individual. But when we think about the order of operations with this, we want to make sure first that you are maxing out your 401k. So first of all, take a look. Are you close to that max out this year? Is there anything that you can do with the final paycheck of the year? If you are not close or it's too late, here's the thing, think about how you configure that for 2026 because you have that time this year to make sure, oh gosh, I really need to make sure that I'm maxing that out. And we think that is just a foundational strategy. If you are able to do so, go ahead and max out that 401k. If I've maxed out my 401k, the next thing I want to look at is going to be a mega backdoor contribution. That is something we're going to talk about in detail, but it is going to be dependent on if you are able to do this in your individual 401k contribution. So I want to max out first, then I want to look at my mega backdoor. Maybe that's an option, maybe that's not. Third thing I want to look at is going to be a Roth backdoor conversion. And that's really going to be making a traditional IRA conversion or contribution, rather. It is not deductible. And then I'm going to immediately convert it sort of as a two-step process. And that's going to help you take advantage of those tax-free or tax-exempt strategies. The other thing is all three of those are available without income limits, which we'll talk about in some detail. Many times we see clients who are just not able to contribute to a Roth or a traditional IRA with traditional phase-out limits. And then the last step of this, if we think of that order of operations, is going to be doing a type of conversion on a traditional IRA or an account that you already have. That is usually going to be the last bucket, but all four of those strategies are very fruitful to look at year end. So if we look at this and we talk about funding retirement accounts now, we actually talk about sort of the nuances with all of this. There are different considerations. There are phase outs with income limits and also just what's available to you in your workplace retirement plan. Every place is a little bit different. It is definitely worth sort of looking under the hood. I feel like many times individuals don't have a good understanding of what is available to them with their workplace plan. And this is one of the most important things you can take advantage of. So we talk about just at first those traditional pre-tax limits. That's going to be $23,500 or $7,000 on a traditional IRA this year. It is higher if you are over the age of 50. With a Roth 401k or a Roth IRA, if you're able to do that, Roth 401k is a wonderful option. We don't have to worry about any type of phase out limit on that income. On a Roth IRA, we do have to worry about a high income phase out, but if that is available to you this year, maybe this year was perhaps lower in income, perhaps people have a gap year, take advantage of that. If you have a year where you are able to contribute every single year, that really does make a difference. And then you also have the three strategies that I mentioned previously. You've got conversion, backdoor Roth, and then mega backdoor Roth. And looking at this, I think the one that's sort of eye-popping is always the mega backdoor. If that is available to you, you do want to make sure that your employer allows after-tax contributions and that you're able to convert that. But the limit for that is $70,000. You want to make sure you take into account any match your employer has made. But this is really where we start to see very impactful types of contributions for individuals who are able to do this. If you look at this year and you go, hey, it's too late for me now, make sure you look at that right now for next year and start anticipating and planning ahead, because it is going to be that compounded strategy year after year where you make these decisions. So these are fantastic opportunities if you're able to take advantage of them. And then, Andrew, I think it is time to go over some final retirement or final checklist items, if you will, for 2026.
Yes, thank you, Sam. And in addition to review, there's just an additional point or two that I think is important or germane, especially at this juncture in the year. And that is like with many things, investing is often about timing. These next couple of weeks in particular are very critical for those that are in the position of trying to find last minute tax advantaged moves, whether it be investment or after tax related. And in particular, some of the options that we've outlined today, you really don't have the opportunity to take action through the end of the year. The deadlines actually may be more fast approaching, which I'll outline here in just a second. But we wanted to give you a bit of a peek behind the curtain as to what we're focused on with helping a lot of our clients in this space as we approach the end of 2025. So from a portfolio perspective, in addition to the traditional focus on optimization of the investment strategy or perhaps rebalancing as you enter a new market environment in 2026, we really want to assess the opportunities to reduce taxes through the harvesting of losses and gains that we hit on earlier, and to plan carry forward opportunities into 2026 that may instruct strategic decisions that improve the situation even into the coming tax year. From a long-term retirement planning standpoint, we want to ensure that we're taking full advantage of retirement accounts that Sam just outlined, determining if you can do something like a mega backdoor contribution or whether or not perhaps a Roth conversion strategy makes financial sense given your circumstances. You'll typically want to max out contributions to your traditional plan at your employer, but that can also often depend on the level of your employer's match, your income level, or the types of expected deductions in a given year. And so there can be some additional complexity worth wading through in the month of December as you figure out where to put your hard-earned dollars from an investment or savings standpoint. And we talked earlier about a couple of different gifting strategies. One of them was the donor advised fund in particular. And this is the area where the timeline gets a bit compressed fairly quickly here over the next couple of weeks. Many of the donor advised options are going to have a deadline of, say, December 15th, give or take, in order to get your contributions in motion so that we can ensure that they're fully settled by the end of this tax year, making sure that you receive the full benefit. So we'd encourage anybody that has interest in trying to determine if there are these tax savings moves that make sense for them to give it a look relatively quickly so that you can scope and investigate what might be appropriate for your individual circumstances. And then lastly, there's a few operational items that we always look to ensure are solidified this time of year. For some of our clients or investors that have company stock, you'll want to be mindful of the tax implications from things like restricted stock units, in particular, trying to avoid any big surprise tax bill in 2026. Now is the time to max out other tax advantage vehicles like a health savings account. And then there's just general housekeeping items that you always want to make sure you have in good order, like keeping your beneficiaries updated and accurate. The last point I'll make is that each one of these tactics that we covered today can often be valuable just as a standalone. But we see the most successful investors having a truly coordinated strategy to ensure they're not only maximizing investment returns, but they're using this full suite of tax strategies to maximize the benefit to them, really at the end of the day, focusing on keeping more of what they earn. So we hope that this final checklist and summary of tactics that you can be evaluating as we head into 2025 has been a useful few minutes. I do just want to leave you with a friendly reminder that we have a team of advisors here to support you if you have additional questions or if any point you'd like to explore any of the strategies that we've reviewed today, we'd encourage you to give us a call. You can email our team. You can see on the screen our website at www.evergreenwealth.com. And we'd be happy to schedule a complimentary consultation to help you determine what, if any, of the opportunities that we talked about today might help to improve your financial position going forward. So thank you very much for giving us some of your time today. We hope this was valuable, and we wish you a happy and safe holiday season and a successful finish to your 2025.